Known as a contrarian, he holds the status of both squawk newsmaker and master of the market. Marc Faber, otherwise known as Dr. Doom, is the editor and publisher of Gloom, Boom, and Doom Report. And Marc, thanks for joining us this morning.
It's my pleasure.
You're going to scare...
By the way, I don't deserve these compliments.
Well, you're going to scare everybody because I was going through some of the notes, and you say that right now the crucial question over the next decade is not, quote, where will my returns be highest, but where will I lose the least money? Why do you say that?
Well, basically, I think that the whole bailout and also the money printing will not create long-lasting wealth, nor will it create healthy economic growth. And if I look at the world, then I see essentially well-to-do people that have done unbelievably well, and I see the middle class and the working class that hasn't done well. And I think somewhere down the line we will have a massive wealth destruction that usually happens either through very high inflation or through social unrest or through war or a credit market collapse. Maybe all of it will happen, but at different times. So I think that Marc, people have to...
I'm sorry to interrupt you, and it's great to have Sorkin. Cody is proposing to acquire Avon for $23.25 a share. It's a $19 stock. It looks like a bear hug to me, Andrew. In a letter to Avon's board of directors, Cody is expressing the desire to open negotiations aimed at reaching a mutually agreeable and negotiated transaction.
They say following extensive but unsuccessful attempts to engage Avon in discussions
decided to try and talk. They decided to try and do it. It looks like they weren't getting any satisfaction from Avon's board. The stock is already well above the $23.25 price. It's already trading $24.50 to $24.73. This would be a big deal.
But it says it has no intention of pursuing a hostile bid for Avon, so we're going to see what this really means.
So what is it then?
Give me a minute to go through it. Let me finish.
It's in play, though. I mean, it's up at $24.50, $20 to $24.50.
Let me finish up with Marc, and then we can come back to this news. Marc, I just want to understand, because you could be scaring the viewers, including myself, when you say that there's a downside, how big a downside? Put a number on it.
Well, I mean, I would say that well-to-do people may lose up to 50% of their total wealth. They'll still be well-to-do. Instead of $1 billion, they'll have, say, 500 million. But I think there is a massive wealth destruction coming down the line. I'm not saying it will happen tomorrow, but I think looking at the bailouts and the money printing, they basically have postponed the problems and actually made them larger, in the sense that the government debt has increased dramatically, and somewhere a solution will have to be found for this government debt.
So, Marc, we have Sally Krawcheck on the set, and Sally, if you heard Marc this morning, or rather, if your clients were watching this morning and they heard Marc, and then they called you and they said, Sally, what do I do? What do you do about a prognosis like this?
Well, I think, Marc, isn't the answer you hold more gold? I wish this were real gold. Isn't it? Is it you're holding on to stores of significant value, right?
Well, I think in my report I also pointed out there is one asset class that is relatively depressed, and these are properties in the south of the United States, say in Georgia, in Arizona, in Florida, and so forth. I think their property values will not collapse much more and will stabilize. And so I think to own some land and some properties, not necessarily in the financial centers, but in secondary cities, is a desirable investment, relatively speaking.
So I'm looking at...
And then I think that people should own some gold, and I think that people should own some equities, because before the collapse will happen, with Mr. Bernanke at the Fed, they're going to print money, and print and print and print. And so what you can get is a bad economy, but rising equity prices.
Marc, thank you for depressing us this morning. We appreciate you being with us.
No, it's not my intention to depress you, but I think we have to think realistically that the debt contraction basically has been postponed. But the huge debt is still there and still growing. You look at, say, student loans. I don't believe that all the students' loans will be repaid ever.
Mark, we're going to have to run, but what is the tipping point, just so I understand? I know you're calling this as sort of a decade, that you expect this will happen in the next decade, but what do you imagine would be the tipping point? What is going to set off that hyperinflation that you expect?
Well, I'm not necessarily saying hyperinflation will occur, but I think that we can have first inflation in asset prices as we had in the last 20, 30 years, and then that asset prices will come down like the real estate market came down in the United States for residential homes. And what will be the trigger? You never know for sure. I mean, I didn't know that the NASDAQ would peak out on March 21st, 2000, and then collapse by 70%. Right. But I knew that it would happen.
Okay. Mark, thanks for joining us.
It could have happened from a higher level or from a lower level.
Right.
That is the difficulty, and I always tell investors, the problem, and fund managers, the problem is if you go 100% into cash, right, and you have money printing, and asset prices continue to go up, you may lose all your clients, or you may lose the purchasing power of your money because we have negative real interest rates.
Mark, I want to say thank you for, listening to you makes me nervous. So it's a good way to start the morning.
Well, I think you should be nervous. I think that
okay. We got to run, Mark. Thanks so much. Appreciate it very, very much.